After you have determined your stop-loss point based on risk management, and after you have set your potential profit goal, there is not much theory involved in the process of entering a position. You usually enter after a small counter wave move, and that's it. No need to try to precisely pick the right moment. You just enter and let risk management and probability love do the rest. Some traders like to enter after a price breaks the previous high or resistance in an uptrend or the previous low in a downtrend. This depends on your preference. I prefer to enter a bit earlier, trying to catch a few extra pips. After determining your entry and stop-loss points, try to evaluate the likely point at which you will close the trade with a profit. Price often move from one resistance level to the next and vice versa in a downtrend. Those lines are psychological, but they are valid because traders use them as a reference and act upon them. The price that broke the former resistance level on the move up has a tendency to go to the next resistance level. Try to evaluate whether there is any profit potential at that level, which is at least double the size of your stop-loss level. If yes, it may be a good trade from a risk-reward point of view. You will often place a stop slightly below the former support level in an up move and vice versa in a down move. Round numbers represent another kind of level that acts as an invisible support or resistance. For example, a price will probably stop at 1.2300, then at 1.2400, etc. It will stop every 100 pips, after which it may break this level and continue or bounce back. Always look at round numbers as an invisible resistance or support level and act accordingly. Some traders enter and exit their entire position at once. Others use scaling in and scaling out techniques. Scaling in is the entering part of your full position. After a price moves in your desired direction, you may enter, for example, another third of your full position. This is scaling in. The same is true for an exit. You may exit, for example, 1/3 of your position at your first profit goal, then let the price develop further. When using scaling in and scaling out techniques, you will lock in at least part of your planned profit. Some traders use pivot levels for entering and exiting trades, especially in short-term trading. But pivot levels' efficiency is dependent on traders who obey and act upon them. In my subjective opinion, there are many more significant signals on a chart to act upon. Remember that in trading, simplicity is king. When making trading tactics, try to get rid of any noisy indicator that may complicate your life as a trader. The simpler the indicator is, the more traders understand it and act upon it, and as a consequence this will make for a more robust move. Research has shown that the more information people have on a particular topic, the more confused they become, by having too many often contradictory data informing their calculations.